Reinsurance is a crucial aspect of the insurance industry that involves transfer of risks from primary insurance companies, ceding companies, to reinsurance companies, also called reinsurers. The primary purpose of reinsurance is to help insurance companies manage their risks more effectively by sharing the financial burden associated with large and catastrophic losses. Types of reinsurance. Proportional reinsurance. In this type, the reinsurer assumes a specific percentage of the risks and premiums from the primary insurer. The reinsurer shares both profits and losses in the same proportion. Classification of proportional reinsurance. Quota share reinsurance. The reinsurer agrees to accept a fixed percentage of each policy written by the primary insurer. Surplus share reinsurance. The reinsurer takes a certain percentage of the policy's limits or liabilities that exceed a specified amount. Non-proportional reinsurance. In this type, the reinsurer only pays claims after the primary insurer's losses exceed a predefined threshold, such as a deductible or retention limit. Categories of non-proportional reinsurance. Excessive loss reinsurance. The reinsurer pays for losses exceeding a predetermined threshold. Stop-loss reinsurance. The reinsurer covers losses once they exceed a certain aggregate amount within a specific period. Reinsurance products. Reinsurance companies offer various products tailored to meet the needs of primary insurers. Common reinsurance products. Property reinsurance covers risks related to property damage caused by events like natural disasters, fire, or theft. Casualty reinsurance provides coverage for liability risks, including general liability, professional liability, and product liability. Life reinsurance deals with risks associated with life insurance policies, such as mortality and morbidity risks. Health reinsurance covers risks related to health insurance policies, including medical expenses, disability, and critical illness. Specialty reinsurance includes niche products like aviation, marine, energy, and cyber reinsurance, tailored to specific industries. Reinsurance processes. Underwriting. Reinsurers assess the risks involved in a policy and determine the terms, conditions, and pricing for assuming those risks. Placement. Once a reinsurance contract is negotiated and agreed upon, the reinsurer issues a policy that outlines the terms and conditions of the reinsurance agreement. In the event of a claim, the primary insurer assesses the loss, and if it exceeds a predetermined threshold, they notify reinsurer, who then evaluates claim and reimburses primary insurer accordingly. Risk management. Reinsurers employ advanced risk modeling techniques to analyze potential risks, manage their portfolios, and allocate capital effectively. Financial management. Reinsurers focus on maintaining strong financial reserves and managing investment portfolios to ensure they can fulfill their obligations in case of substantial claims. The reinsurance industry operates in a cyclical pattern influenced by several factors, including supply and demand dynamics, catastrophic events, investment returns, and regulatory changes. The reinsurance business cycle typically consists of the following phases. Soft market. During this phase, reinsurance capacity is high, competition is intense, and prices and profitability may decline. Insurers can obtain reinsurance coverage at relatively lower costs. Hard market. In this phase, reinsurance capacity tightens, resulting in increased demand and higher prices. Insurers may face challenges in obtaining reinsurance coverage at favorable terms, and profitability for reinsurers typically improves. Transition phase. The transition phase occurs between the soft and hard market cycles. It involves a shift from an oversupplied market to a tightening of capacity. Reinsurers may start adjusting their pricing and terms as market conditions change. Market turn. The market turn is the point where the soft market cycle transitions into a hard market cycle. It often follows a significant catastrophe or series of large losses that impact the industry's profitability. Reinsurers respond by reducing capacity and increasing prices. Stabilization phase. Once the market reaches its peak in terms of pricing and capacity, it stabilizes. Prices become more consistent, and reinsurers adjust their underwriting strategies accordingly. Retrocession. Reinsurers may further transfer their risks to other reinsurers through retrocession. This process allows them to manage their own risk exposures and protect their balance sheets. Segmentation in reinsurance. The reinsurance industry is segmented based on various factors, including lines of business, geographic regions, and client profiles. Some common segmentation categories include property and casualty reinsurance. This segment covers risk related to property damage and casualty liability, such as natural disasters, accidents, and liability claims. Life and health reinsurance segment focuses on risks associated with life insurance, including mortality and morbidity risks, as well as health insurance risks like medical expenses and disability. Geographic segmentation. Reinsurance companies operate globally, and they segment their business based on geographic regions to better understand and manage risks specific to each market. Reinsurers may differentiate their services based on the size, type, and specialization of their clients, such as multinational insurance companies, regional insurers, or niche market participants. Other relevant industry details. Regulation. Reinsurance is subject to regulatory oversight, which varies across jurisdictions. Regulatory bodies ensure solvency, capital adequacy, and compliance with contractual obligations. Catastrophe risk modeling. Reinsurers utilize sophisticated models to assess and manage catastrophe risks, enabling them to price policies accurately and allocate capital effectively. Capital markets integration. Reinsurers may access capital markets through instruments like catastrophe bonds, insurance-linked securities, bills, and sidecars to enhance their capacity/manage risks. Global reinsurance market is dominated by a few large reinsurers, often referred to as global reinsurers, who have extensive underwriting capabilities and broad geographic reach. Technological advancements, such as artificial intelligence, data analytics, and blockchain, are increasingly being integrated into reinsurance processes to improve the processes. Please note that the reinsurance industry is complex and constantly evolving, with variations in practices and market conditions.